Hello, everybody, and welcome to the Trading with Ashley show. I am really excited to bring you this particular video because this is something that is on my wish list.
In today's video, I am going to show you the math on how you can take less than $200,000 and create for yourself an annual salary of $120,000. So that's about $10,000 a month. Now we're going to do this with a combination of LEAPS and then selling calls against those LEAPS.
Now, I know that there are several indicators out there that we could be entering into a scary time in the market. Well, I have always said if we get the opportunity, and let's say we do have a market correction, either if it continues through September, which has already been kind of rough, or if we have a larger correction next year, I have got one particular ETF on my wish list, and I plan to use it to make weekly income. And that is the SPY, ticker symbol SPY. So what I wanted to do for you today is to show you what my plans are. I am blessed enough to be in retirement. I retired young once I learned how to trade for a living. And I wanted to use the SPY as a vehicle to make weekly or maybe monthly income. That's the best part about trading, especially with a vehicle like the SPY, because you can trade the SPY daily, weekly, monthly, quarterly. You can even get a little crazy and trade it annually if you'd like. But it's the one vehicle that continues to go up over time, and that gives you confidence. Well, why does it constantly go up over time? It's because it's a blended ETF with 500 of the best companies all put together in one place. So you are not at the mercy of one CEO quitting and it crashing the stock like recently happened with Chipotle. You are not at risk of a company being investigated and then it tanking. You're not at risk for those nuances that happen with individual companies and their balance sheets and their earnings. This is a blended fund that's got the best companies in it. So that's why it traditionally goes up over time. It can absorb one or two companies having some trouble. And it rebalances on a quarterly basis. And recently we heard that Palantir and Dell are going to be entering the S&P 500. So they put companies in and they pull companies out. So they're constantly churning and making sure it's the best of the best in there. That's what makes it a safer bet. But when we have market corrections, we see that go down too. And so I wanted to teach you today how to purchase a LEAPS on the SPY. And then I'm going to teach you how to sell regular calls against that LEAPS. The best part about the LEAPS is you don't need the cash to purchase 100 shares of the stock. You just need to purchase a longer dated call, a year or more out. To me, the further the better that you can afford, because it does have that tendency to want to go up. And so if that's the case, go out as far as you can and take full advantage of the prices that we have when we pull back. But I'm going to teach you how to do this in a way that you can grasp it and understand it. And then you can have the gift that keeps on giving over the next year, year and a half, even maybe 2 years, if you go ahead and purchase one that's longer dated. Also, I wanted to offer you some facts about the S&P 500 because I found it interesting as I was doing my research for you. So here's some of the facts that you may want to know. Did you know that the S&P 500 used to be the S&P 90? It actually began in 1926, but in 1957, it became the S&P 500 and it was introduced to us by Standard & Poor's. The beautiful thing about the S&P 500 is it covers an array of sectors. We've got technology, healthcare, financials, consumer discretionary, and energy. And if we're talking about a popularity contest, the S&P 500 is the most popular vehicle to invest in the stock market. If you are working with a lot of money in retirement, I always tell my students, I try to limit myself to about $500,000 that I am trading the wheel strategy on. That will ensure it stabilizes your portfolio and it continues to produce income for you week after week, month after month, and year after year. because we want you to live to a ripe old age and have plenty of money in retirement to do whatever you want to do. Before we get into too much of the detail, I want to share with you my perspective on what a LEAPS is and then what selling covered calls against your LEAPS is. I love to use analogies, so let me explain this in the clearest way that I can. If you are going to purchase a LEAPS, I look at that just as you would building a home that you plan to rent. So you would want to obviously build the home the least expensive way that you could. So when you're purchasing a LEAPS call, you want to potentially buy it on a red day. That way you will be buying it when it's less expensive. So that's the first thing to consider. But the reason that I look at it like a house is you will start to sell calls against your LEAPS. I look at that as the short-term renters. So maybe you sell weekly calls or monthly calls. So you have weekly or monthly renters. And over time, the premium you're collecting from selling the calls will eventually pay off your mortgage, which is your LEAPS. And then you will have the LEAPS owned clear and free with the money that you generated from the covered call premiums. Now, I like to look at it that way because if I put it in the context of a real estate example, it helps me better understand what the purpose is of the LEAPS. It is to gain value over time, just like real estate would do for you. If you purchased a home, eventually over time, that home would gain value and you would hopefully be able to sell it for more than you purchased it for. And then you've got the short-term rentals that help to cover the mortgage, and eventually they pay off that house, and then anything you sell the house for is 100% profit. So using that analogy, now let's go look at some technical analysis so that we can get the best possible price for our house we're about to construct. I am looking at a chart in Yahoo Finance, and I have selected the 6-month range. Because the further out you go when you're looking at technical analysis, the more accurate it will be because there's more data to feed into the equation. So if we're looking at this, like I said earlier, the first thing you want to consider is it a red day for the SPY? And if the answer is yes, then you have passed test number 1. The second thing to consider is the price action in the lower portion of the Bollinger Band? Ideally, it would either be at the bottom of the band or slightly under the band. Notice when a stock, or in this situation, an ETF, goes outside of the Bollinger Band, it doesn't stay there long before it retreats back under the cover of the band. So if you are fortunate enough to purchase an equity or a call when the price action is below the band, then that gives you a much better shot at having profitable weeks ahead. And so the lower the price, the further under the band you go, the less risky this play is. Now, if you are looking at the bottom of the band, you will also notice down here on the RSI, anytime this number is under 50, and especially if it's closer to 30, we are entering into the category of something being oversold. Well, ideally, you'd want to buy something when it's oversold because more than likely it will then start going back up. So the closer you can buy your call LEAPS when the SPY is closer to 30 on the RSI, the better chance you have of riding the elevator up and collecting all the money along the way. Now, another technical indicator for you to consider is right here, the 200-day moving average. I have put it in red because it's very important to the price action of a stock. The 200-day moving average traditionally serves as very strong support for a stock. And if it dips below it, then ideally it will come back up before too long and it'll start heading the other direction. But what you want to look at here, if you were considering the SPY, the best possible entry for me personally would be if we do happen to have a deeper correction and the SPY dips down below this 200-day moving average. If you go and look over time, when that has happened, when it's gotten close to the 200-day moving average or dipped below, it then quickly came back above it. And so that is something to consider, and it is the best possible entry for a stock. So if your budget allows and you want to get into this game now, you could just go for a price that is under the Bollinger Band or at the bottom. And then if it continues to drop, maybe you add more if we dip below this 200-day moving average or we get close to it. Now I am going to take you to the option chain so that we can actually go look for our SPY house and we can select the best possible price. Remember, again, you want it to be a red day, and you want to keep in mind those levels on the Bollinger Band before you take this very critical step of actually purchasing the LEAPS call. Once you're satisfied with the price action of the SPY, then the next order of business is expiration dates. For something to be a true LEAPS, it must be at least a year out from the current date. However, I like to go as far as I can on the chain, especially with something like the SPY, because over time the SPY always goes up. That way I can enjoy having this price action for quite some time. And the further out I go, the less I have to deal with the annoyance of time decay. I am going to select that expiration date, and I am going to now go look for the right level to purchase this LEAPS. Before we do though, let's consider how much it would cost if we were to buy 100 shares of the SPY right now. With the SPY trading at around $5.40, it would take us $54,000 to purchase 100 shares to then go and sell covered calls against the SPY. That's a lot of money. So let's go see if we can find a better option. The main thing I want you to consider is the delta. It is one of the Greeks. In my opinion, it's the most important Greek. It's the one I refer to the most when I'm trying to find the correct strike price. The sweet spot, if you're buying a call, is usually to try to find something around the 0.8 delta. Now, we have a few options here. We have the $450 strike price, and it's at a 0.79 delta. And actually, when you look at that, it seems to have the most volume and open interest than any of the others around it, even though those are close to 0.8 as well. So I think I'll settle in on this $450 strike due to that type of volume and open interest that it's showing right now. Now, why is this 0.8 important? Well, you don't want to overpay for your home. And if you are going for a 0.8 delta, that's usually the sweet spot where you can enjoy price appreciation, but you're not overpaying for the call. And so if you look at this, it is showing $135 is the price that it's being offered for right now. Now, keep in mind, this is $135 a share. So you're looking at $13,500. That's a lot of money. However, it is a lot cheaper than $54,000 to operate 100 shares of the SPY. So if we are satisfied with this particular price, then we would go ahead and buy this call option. To buy the call option, it looks like this. Once you send it to a ticket, you have all the information pre-populated. You're looking at 12/18 of 2026, the $450 strike. It's a call option. You are buying to open, and in the quantity, you would want to select one because one call option will give you the buying power of 100 shares. I do not traditionally select market because that leaves me a little bit vulnerable to whatever the market maker wants to fill the order at. I like to select limit, and then I try to go for a strike price that's between the bid and the ask. I like 135, so I'm going to populate that right here. Typically, you make these good for the day, or if you're wanting to ensure that it triggers on a massive drop, you could go ahead and populate a much less expensive price, and it will just be held if you do a good till canceled, and it will fill automatically if the SPY gets down to that level. But typically, you'll just go ahead and look at the price action on a given day and select day. Now, once you have purchased your call option, now let's go and see what potentially this new call option will be worth if the SPY continues to rise. If we want to stick with my analogy of a home, we want to go see how much our home will appreciate in price by the time we want to sell it. Now, once I get to the option calculator, one of the first things I want to look at is my break-even price. And here it is right here. If I purchase this particular LEAPS at the $450 level, then my break-even price is $585.50. What this means is on my expiration date of December 18th, 2026, the SPY must be $585 for me to overcome the fact that I spent this $13,550 on the call. Now, this looks very reasonable because the SPY will traditionally jump anywhere from 8 to 12% annually. Well, if you look right here in the span of 2.3 years, it's saying it just has to rise by 8.3%. So I feel really good about the potential of at least a break even for this. Now, if you want to consider how much it's worth, then let's look at the percentages based on what the SPY traditionally does in a given year. So if we are expecting potentially a 10% return per year, then within a couple of years, you could assume that we'll be right here, probably at around the $645 level at least. Well, at this point, now let me see how much money I will make on the appreciation of this call option. To do that, I switch over to profit and loss, and now I just want to simply go along this green line, and I can start to see as I approach my expiration date how much money I will have made. If in June of 2026 the SPY is at $645 or higher, then I would have made at least $6,879. So that's exciting because that is simply the LEAPS option itself. This does not even account for the fact that I will be selling covered calls along the way. Okay, now that I've shown you how to purchase a LEAPS and what to look for, you've purchased it, you're ready to go. Now I am going to train you on how to properly sell covered calls against your LEAPS. We're going to look at what delta to use, what price to consider. You'll have everything you need to trade after this next segment. If you decide to sell daily calls against the SPY, that's fine. However, just keep in mind that that is very labor intensive. You're going to have to watch it along the way to ensure if it gets close to your strike price that you roll it to the next day to avoid assignment. For this example, I'm going to settle in on a weekly call. Then I'd want to go to my option chain, and you go all the way down to where the price action is. Now, calls are on the left and puts are on the right. We're still on the call side. And this time, instead of buying the call, which we did much earlier, we're going to be selling a call, much shorter dated call against the LEAPS that we purchased. To open up the trade, we want to go back to our deltas. It's a very important factor. Now, typically when I am selling calls against any stock, I like to start around the 0.2 delta. The reason this is important is it is showing you that it's about a 20% chance by our expiration date that it will hit the strike price if you were looking at a 0.2 delta. And obviously, the higher you go, the more premium you'll receive, but you are increasing your chances of it breaching your strike price the higher you go in delta. But as I look at this particular chain, one thing does stand out to me. If I am looking at the volume and open interest, I can't help but notice, but this $550 level right here, this has got the most volume and open interest. Now the delta is 0.246, so it doesn't quite meet my criteria. But what you might want to consider doing is going one level above where all the action is. The simple fact that you have so much volume and open interest here really helps to protect your trade. meaning if it were to get to 550, this might cause some selling pressure, and if so, then it would retreat away from your strike price. So with that being said, I think I'll settle in right here on this 551 strike. To sell this, I will be receiving at this point in time $1.48 a share. So because I am representing 100 shares with my call, this is $148. This weekly income represents the renters I was sharing with you. So if you have weekly renters, which are the calls that you're selling against your LEAPS is your home, then you will be receiving on average about $150 a week. Now keep in mind, this is on a red day, so this will more than likely be higher on a green day, which would be great because you could make anywhere from $150 up to $250 a week by selling covered calls. So let's assume that we're going to be making conservatively about $175 a week. If we go back to the cost of our initial call, $13,500, here's what I like to do to see how long will it take me to pay off the mortgage on my house. So the way that I do this is I take the $13,500 and I divide it by $175 a week. That gives me 77.14. So this is telling me that it would potentially take 77 weeks of selling call options to pay off the price that I paid for the home. Well, that's not bad considering there's over 2 years left in this particular call option. So with 116 weeks left in this trade, it's nice to know that if I am selling covered calls, that I could have this complete trade paid for in about half the time, which is great because in addition to making money weekly on the covered calls, and I'd have it completely paid off in about half the time, then every week thereafter is profit. I also have the profit of the instrument itself. So going back right here, you see if we get to 645 and we're towards the end of the life of this call option, I've made all that money on covered calls. Plus, I still have what I can make when I go ahead and sell this at the end of its life cycle. And at that point, you're looking at about $6,642. Let's go and break down the math so you can see how this works. If your desire is to produce $10,000 a month in income to live from, then let's see how many LEAPS we would need to purchase to make this happen. Well, one LEAP was $13,500 at the level that we looked at. If we are able to produce $175 a week from that one LEAPS, multiplied by 4, we're now looking at $700 monthly. Well, you would need about 14 of these to produce a monthly income of $9,800. Okay, so now let's go see how much that cost. 14 LEAPS at $13,500 would equal about $189,000. So you could make this purchase. Now you will be producing each year for making this purchase $120,000 in income. Then when you get to the end of the life for your LEAPS, we are looking at approximately a $6,500 value from what we looked at before. So if you take 14 times 6,500, that equals $91,000. That's a great bonus you'll receive at the end of the life of your LEAPS. Now you can take that money and go fund new LEAPS so that you can keep the money train going. I hope you found this helpful. Share it with someone who is retired or considering retiring if they want to get into trading. It's one of the safest ways I have found to trade in the stock market. Don't forget, you need to keep learning, keep earning, and I will see you on the trading floor.